Thanks, Margaret. All right, so let's now talk about contributions and employer matching. All right, so a key benefit of business retirement accounts is the opportunity for business contributions or matches. So what does that mean? That's where the child care business makes additional retirement contributions or matches employee contributions towards the employee's retirement. Now, we're going to discuss this a little further in the next section, but most plans do allow or even require for companies to provide some type of contribution to an employee's retirement. So these contributions, they can be a set amount, a percentage of the employee's compensation, or they can be a match. And what does a match mean? It means that the employer will contribute the same amount that the employee contributes up to a certain percentage. So that's very attractive. And an example of that would be if an employer offers to match the money that is contributed to a retirement account, let's say up to 3% of an employee's salary. So this could mean that a person who earns $30,000 a year, let's say they contribute 3%, which is $900 annually. In this instance, this example, the employer would also contribute or match the $900, and that means that that annual contribution then goes up to $1,800. And if we think about that whole compounding interest concept, that can grow pretty fast, right? And the employee has made this 3% commitment, and you've made a 3% commitment, and working together with that money, wow, it really, really can grow. And match really is, it's essentially free money for the employee, right? It's a commitment from you, and it's an incentive for employee retention, since they are getting additional funds beyond their contribution. So when you think about the employee contribution and the employer match, and then compound interest, wow, that can really grow retirement savings for your employees, and that becomes very, very attractive. Now there, so when it comes to contributions and matching money, there's a concept called vesting. And what vesting is it means that the employees, the funds that you have contributed as an employer to the employees' retirement funds, investing basically means that there is an amount of time that it would take for the retirement account, the portion that your business put in, for the employee to fully own that. And that's a decision that you make. So what is vesting? Vesting basically means that an employee is contributing their own money, which is theirs, but you may set a time which the employee has to stay with you to receive your amount of the contribution. All right. So businesses can choose for employees to become vested upon hire, so you don't have to do vesting over time if you didn't want to. But you can also require a certain amount of time, which would be up to 6 years, for an employee to become vested. So how does vesting work? Well, let's say you make a $600 contribution to your employee's retirement account in 2024. And we have a 3-year vesting schedule. So typically what that would mean is that if your employee left the business at the end of 2025, so all of 2024, 2025, they would only receive a third. And then if we go by our previous example, or they have the $600 contribution, they would only be able to take $200 with them, and the rest of your match contribution would return back to the business, right? Because they're only considered to be partially vested. They haven't stayed in this instance for the full 3 years that you set the plan up for. If they leave then at the end of 2026, still only partially vested, and 2/3 of the money, which would be $400, they're allowed to take with them when they leave. It wouldn't be, because this is a 3-year vesting, it wouldn't be until the end of 2027 that they would have the full $600 that you contributed to their plan. At that point, they're considered to be fully vested. So if you have a vesting period, if you implement a vesting period, that encourages employees to remain employed at your childcare business because they want to be able to take and access 100% of the contributions that you made to their retirement plan. So vesting is very, very common. You don't have to set up the retirement plan with vesting, but now that we've seen it, it really can help with employee retention. So many employers do set up some form of vesting for their employee retirement plans. All right, so everyone wonders, okay, we've talked about the employee, my contribution to an employee retirement plan. How much should I contribute to my employee's retirement plan? Now, most business contributions are on average 4.3% of an employee's annual salary, but there are some considerations to take in mind. So one thing that you need to do is you need to look around and make sure that you are remaining competitive in the amount of money that you are contributing to an employee's account. So you're going to look for other childcare providers in the area, right? So what are they offering? Because the retirement benefit is just like any other employee compensation. You want to keep up or possibly surpass other businesses so employees don't leave, and so it's more attractive for potential employees to come work for your business. When we think about the fact that turnover can be costly, right? Employees leaving our business costs us money. Basically, 1.5 to 2 times of an employee's salary, according to LinkedIn, is what turnover costs. So when you factor in the amount of time that's needed to recruit someone and then hire for the open position, overtime hours that may be needed from other employees to fill the lost capacity, and the time and cost of onboarding. So that's a pretty large expense when you have turnover and an employee leaves your business. So if you look at and on a regular basis, look at the retirement plans that your competition is offering, it can help you keep your staff, reduce the cost of turnover, and entice employees to come work for you. So when we think about what we're going to contribute, you always want to consult your budget before making those decisions, right? Because we want to make sure that we have the cash flow to make those contributions. But I'd like you to keep in mind that those contributions are a business expense and they are tax deductible. So again, you're contributing to your employee's future, but that is an expense that you can take as a tax deduction. All right, now matching. So matching is the concept, right? When it comes to an employer's contribution, the majority of employers in the United States, if a retirement plan allows it, opt to have a matching component to the retirement plan. So what is it? What is a match? It means that an employer will contribute only if the employee makes a contribution. So the employer isn't contributing unless the employee is as well. So typically a match is 50% of the employee's contribution up to a certain level. It's not unlimited. So let's assume that an employer has a 50% match up to 3% of an employee's total salary. So if an employee makes $35,000 and they contribute 3% of their salary for retirement, which happens to be $1,050, the employer then puts in half of that, matches half of that, which is $525. So matches are very attractive to employees. It's free money, right? It's something, and it's showing your commitment to their retirement plan. It's also a great incentive for your employees to increase their own contribution, right? Because they would really want to get the maximum amount of a match that you are offering. So it's not uncommon if you are talking about retirement plans to potential employees for them to right up front ask what the match is, or for you to offer that percentage immediately, right? To let them know as you're interviewing everyone what match you offer, because that is very, very attractive. All right. So when we talked about vesting, I just want to bring up that that is very, very common. So keep in mind that, again, this is an incentive for employees to stay with your business. So I want to think about the example that we just gave, right? So if an employee had to wait 3 years to be vested and they left after 2 years, they may just get if they're vested, they'll only get a portion of that employer match, right? So vesting with the match does work together. So in the example that we gave before, they could only take 75% of the match amount, which would be $525. So really, the match, the vesting is basically something that you set up for your protection to retain employees, and the matching is this great added benefit that your employees have. And again, it's a great incentive once we have that match for employees to stay with your business, and vesting helps ensure that they stay with your business because they don't want to lose out on the funds that you've contributed to their retirement plan. That's how all that works. All right. So you may not have thought about retirement under this method, but retirement plans actually allow you to keep more of your profits through retirement savings. All right, because there are tax benefits and there are potential credits from the federal government, and there are savings for both employers and employees, so helping you keep more of your money. So there's an opportunity to save more of your money in 3 different ways. So one is that keep in mind that the contributions that your business makes to the plan and any costs for maintaining the plan are deductible. And that's the case even if you are the only one receiving the retirement benefit. So if you contribute to a retirement plan that's set up through your business, and any contribution that you make means that you have that money for yourself in the future, but you also have a tax deduction for the business. So that's very, a really very interesting and amazing way to lower the tax liability for the business while putting money into your own future. It's the only way that I know that that's possible. I'd also like to bring up that it's actually the only way that you can affect your previous year tax liability up until the close of tax season, up until April 15th. You still have this time in 2024 to start a retirement plan through the business, make contributions to your or your employees' retirement plan, and that reduces last year's tax liability. So it's the only time that you get after the close of a tax year. You've got that time, and remember, you can set up a retirement plan all throughout that tax year. But if you come to, let's say, January 1st, and you look back at the profit that you had in 2023, you look at it today, right, the middle to the end of February, look at that number and you say, wow, I have more profit than I expected last year. I'm really surprised. That means I'm going to be paying a little more taxes, but oh, now I actually could take some of that extra profit and I could go ahead and put that into a retirement plan for myself and my employees, reducing last year's tax liability. You still have time to do it. I wouldn't wait until that second week in April, but think about it now. This is a way you put money towards your own future and you reduce the tax liability for the business. So it's a huge win-win. Now, another thing to remember about retirement plans is that they are often tax favored. And we'll go into that in just a moment. And then the other thing that exists that we'll talk about is that retirement contributions can get you tax credits. So we do have these three areas that retirement savings help you with savings for the business as well. So, as you know, and personal, right? Personal savings. So you do want to keep that in mind. All right. So when we think about retirement plans, often business owners think that this is an added expense, but the contributions, remember, the contributions that your business makes to the plan, the cost of maintaining it, even if it's just for yourself, are deductible. As I said, right, that reduces the amount of revenue that's taxed by your business. And that also lands, if you're a sole proprietor, on your personal income tax return. If we are talking about the reducing the overall profit of the business, right? So you get to do this. You get to take the deduction. You get to add the money to your own retirement. If you're a sole proprietor, remember, it does reduce the amount of money that you're paying self-employment tax on, and it decreases the amount of money that you are paying income tax on, right? So you're making that investment in your future. So it's lowering, as a sole proprietor, lowering the amount that you pay the self-employment tax, lowering the amount of income that you show on your 1040 form, thereby having you pay less income tax. So there's a benefit there. Now, we said another benefit is that retirement plans are tax favored. So what that means is that the government gives you tax benefits, and that's to encourage you to save. Now, some retirement plans use what's called pre-tax money, right? And that means that the money that you're putting into your retirement plan now is taken out of your income before it's taxed. So it's not taxed today, right? So that lowers your taxable income. And we're talking about your personal income. And what that does, right, is that allows you to put this money that you haven't paid taxes on yet into the investment. So over the basically, if you put money into a retirement plan that has pre-tax money, when you retire, you would be paying taxes as you withdraw that money. But there are also plans where you pay the taxes today, and then you don't have to pay the taxes when the plan is accessed, when you retire, right? So just kind of keep in mind there. So you could potentially be taxed on money that you put into your retirement plan when you retire, or with certain retirement plans, you'll be taxed now. It'll be your taxable income. It'll be taken after you've paid your income tax, after you've had your taxes withheld, and then you don't have to take the taxes out when you receive that money during retirement. So very, very exciting there. If you had an investment where you weren't being taxed until you took the money out, if we used an example, let's say you had $5,000 that you put in an SEP IRA, I should say, that's not taxed today. But if you gain over $14,000 over the next 20 years, that's taxed when you retire, right? So we're going to be taxed when we retire. So you have those, it depends on the type of retirement plan that you use. Now, retirement plans can also, your contributions can also get you tax credits. So there is the Savers Credit, and there's what's called the Retirement Plan Startup Cost Tax Credit. So a Savers Credit is a non-refundable credit that's available to adults over the age of 18 who are not dependents on someone else's taxes or are not students. The program will give you a credit worth up to 50% of your contributions to your retirement up to $1,000. So you can receive up to $1,000 in credits. If you're married and you have an adjusted gross income of less than $73,000, you can take advantage of that credit. If you're a head of household and you make less than $54,750, you can take that credit. Or if you're single and you make less than $36,500, you can take that credit. So just remember that your adjusted gross income is typically less than your total income. So even if your salary is higher than the limit, think about your adjusted gross income because you may still qualify for the Savers credit. Now, the retirement plan startup cost tax credit is open to employers. That's for employers who have retirement plans that include W-2 employees who are not owners. So this credit is available if you have employees and you're contributing to their retirement plans. The credit was updated at the end of 2022. Not sure, actually, to be honest with you, if there was an update in 2023. So I do apologize. If you do a search of the IRS website, you would be able to find out about that. Now, if a business has 100 or fewer employees, the credit would actually cover up to $5,000 in administrative costs for the first 3 years of a new 401k, 403b, profit sharing, SEP IRA, or a simple IRA plan. So businesses that have less than 50 employees can get a credit of up to $1,000 per employee in the first year of the plan for the contributions that they make if employees earn less than $100,000. So the credit actually continues for a few more years and it decreases every single year, about 25% in each subsequent year. So let's say we had an employee who was earning $32,000 a year and you contributed $1,000 a year to their retirement. Over 5 years, you would get a credit of $2,500. So a credit. So everything that you've been contributing is tax deductible. Plus, through the government, there are available tax credits. So really some great incentives in addition to setting up a retirement plan. All right, so let's just think about how these savings can affect you, how they can benefit you. So we have a situation here where Kashana is a family business owner, family care business, business owner. She's a sole proprietor and she made $38,000 over the course of a year. So she's going to put $2,000 into a simple retirement account, and we'll talk about what the different types of retirement account as we go on in the presentation. The $2,000 basically will save her 3 different times. So she's going to save first because she's got a reduction in the 15.3% self-employment tax. Now she's got a reduction in the 12% income tax. That credit worked out, that savings worked out to be $546. Then it turns out that she qualifies for the Savers credit. So she gets a 50% credit for her contribution. So then she gets $1,000, right? Because she made a $2,000 contribution. So she has $2,000 for her retirement and also has these tax credits. So that means that she saved $2,000, but the cost to her was only $454. So through those credits, through the reduction of the self-employment tax, the reduction of income tax. So now here we have another example, and this is Estelle, and she has a center with 15 employees, and she had stimulus money, and she decided to start a 401k. So her business happens to be an LLC that declared itself as an S corporation when they filed. So the profit of the business goes on her personal tax return. And in this instance, Estelle's taxed at 22%. So Estelle, for her retirement plan, she contributed 5% of the salary of each employee. So let's say that was $1,560 per employee. So that meant the contribution that she made for her employees, it totaled $23,400. Now, between the fees, the costs for her time to set up, and having her bookkeeper help her with that 401k, she paid $2,550 in fees. All right, so between the contribution to the retirement for her employees and the administrative costs, she paid a total of $25,950. She's able to save money, able to save money in 3 different ways. All right, so the 401k is new. So she got 100% of her administrative costs back, $2,550 back. Because her employees make less than $100,000, she can get $1,000 for her contributions for her employee for a total of $15,000. So she got $17,550 in tax credits. Third, she gets the deduction for the contributions and administrative costs. That saves her another $5,709. And in all, her new benefit cost her $25,950, but she saved or received credits for a total of $23,259. All that money that she contributed, she only really spent $2,691. And then she can share the information for the savers credit for her employees, and they'll receive a tax credit and a greater benefit. How amazing is that, right? So as employers, we think this is going to cost us a lot of money, and we're not thinking about all the different credits, deductions, reduction in tax, everything like that. We're not thinking about those and instead focusing on the cost to the business. And in this instance, wow, through this particular step-by-step reduction, look at what that meant, right? So she really, the benefit originally cost $25,950, got $23,000 in credits, only ended up spending $2,600 or almost $2,700. That's amazing. So there really are a lot of benefits for doing this. Now, the next thing we want to do is we want to think about how you choose the right retirement plan. So choosing the right one is going to help you and your employees plan for successful retirement. It provides additional, as we said, right, retention opportunities and can help you save money in the long run. So how are we going to choose the right retirement plan? So here on the screen, we have 4 common retirement scenarios. Now, if we look at this flow chart, look for the scenario that most closely resembles your situation, and that will help you make a decision. So with scenario A, it's just me or me and my spouse, we're under 40. Scenario B, it's just me or me and my spouse, but we're 40 years or older. Scenario 3, I want to be able to vary the contribution I make, if I even make a contribution every year. I don't want to have to be tied into making the same contribution every single year. And scenario D is, let's say I want to set a contribution level, set that amount for every single year. So we've got these 4 scenarios. So I want you to think about which one would apply most to your circumstances. All right, if we have scenario A, just you or you and your spouse, and you're under 40. So when you're younger and you're considering retirement options only for you and your spouse, several options to maximize the benefits because you're going to be saving for a longer period of time. That those are those folks that are starting retirement when they're older. So when you're earlier in your career, starting with a Roth IRA is a great way to focus on your retirement savings. So through the money that you put in the Roth IRA today, it's taxed this year. So you're paying taxes on that. But the compound interest is not taxed. So all of your gains over the many years, will be tax-free in retirement. All right, so you can contribute with the Roth IRA, you can contribute up to $6,500. If you happen to be 50 or older, you can contribute $7,500. That was in 2023. Please look at the 2024 numbers. Now, if your spouse is working either in your business or in another business, they could contribute to their own Roth IRA. If you're single or you're head of household, you need to make less than $153,000 or less in order to participate in a Roth IRA. If you are married filing jointly, you can contribute to a Roth IRA if you're making $228,000 or less. Now, If you're above those Roth IRA thresholds, right? So if you make more money than those, please talk to your investment company, because there is a legal option called a backdoor Roth conversion, and that could allow you to legally contribute to a Roth IRA, even if you're above those income limits. All right. Now, if you want to contribute additional savings, you may want to add a SEP IRA. Now, these plans are very easy. They're fast to set up. They rarely have fees. There are no annual filing requirements. Makes it very, very easy to manage. So SEP IRA contributions are considered to be made by the business, not you individually. So these contributions then become, as we mentioned before, this could be an allowable business expense. So the contribution limit differs based on the type of company you have. So if you are a sole proprietor and owners of a single member LLC, you can contribute up to 20% of your net profit. If you're an S corporation owner or an LLC that is declaring filing as an S corporation, you can contribute up to 25% of your W-2 wages, not your owner's draw, not the distribution of the W-2 wages. So regardless, right, you cannot exceed a total contribution of $66,000. That was for 2023. So if you're going to be working on this in 2024, keep that in mind. Now, make sure that you ask your tax preparer about the saver's credit, right? Because if your adjusted gross income is less than $73,000 if you're married, or less than $54,750 if you're a head of household, you could get back the $1,000 in tax credits. So you'll want to talk to your tax preparer about that. All right. If you want to be able to contribute even more, an individual or a solo 401k is a good choice. They take a little bit more time to set up. They usually don't have fees, usually don't. What's appealing about a solo 401k is not only is it inexpensive and easy to implement, but you can contribute as an employer and an employee. So that creates the ability to save quickly if needed. All right. So in 2023, you can contribute as an employee up to $22,500. $30,000 if you're over 50, and as an employer, up to 20% of your employment income. And these funds aren't taxed in the year that you contribute, but they are taxed in retirement. So if your spouse works with you, works in the business, they can also participate in the SEP IRA or a solo 401k. All right, so scenario B, right? Me and my spouse, or just me, I'm older than 40. So as you get older, it makes more sense to maximize the deductions in the current year, right? Because you are now making more money and there's less time until you retire. So we don't have as much of the benefit of compound interest, right? We have a shorter time period. So those with who are over 40 and you don't have employees, we suggest making a change in the strategy. All right, so the first thing you would want to do is start with contributions to the SEP IRA. Again, easy to set up, rarely have fees, no filing requirements. A SEP IRA only has employer side contributions, all right? So there's no employee contributions. And they're limited to 20% of your net profit for sole proprietors and single member LLC owners, 25% of your W-2 wages for an S corporation owner and the LLCs that are declared as an S corporation owner. So we mentioned that. Again, you can't exceed total contributions of $66,000. And remember, SEP IRA, whatever you're putting in for yourself, tax deductible. So even if you're not making contributions for your employees, and keep in mind with a SEP IRA, your employees cannot contribute to that themselves. You're either making the contribution for yourself or making the contribution for yourself and your employees. They are not contributing. All right. Now, if you want to go even higher, higher amounts of the pre-tax income, we're going to look again at that individual or solo 401k. Solo 401ks are much easier to have. The fees are low, as we mentioned before. They do have the potential for some of the largest contributions of any retirement plan. So you can contribute as an employer and an employee. So basically, as an employee, you can contribute up to $22,500 or $30,000 if you're over 50. As an employer, up to 20% of your self-employment income. Once again, those contributions are not taxed now. They'll be taxed in retirement. And again, if your spouse works with you, they can participate in your solo 401k. Keep that in mind there. If you wanted to diversify your retirement savings, or let's say you maxed out your solo 401k contribution, then you would consider a Roth IRA. So you can see how this scenario is a little different than the one we looked at before. So contributions are taxed this year with a Roth IRA, but all the gains you have across these years will be tax-free at retirement. You can contribute $6,500 up to $6,500 or $7,500 if you're 50 or over in 2023. But to participate in a Roth IRA, remember, you need to make $153,000 or less if you're single or head of household, or $228,000 or less if you're married, filed jointly. And again, remember, there is an option for what's called a backdoor Roth conversion. So you would speak to an investment company about that. Now, if we are in scenario C and you would like to vary the amount of your contribution to your employees, a good choice is the SEP IRA. So let's take a look at that again, right? We said easy to implement, inexpensive. You can contribute up to 25% of an employee's salary per year. So what it does is it allows you to contribute up to 25% in a year or none at all. So you have quite the variety of what you can contribute on behalf of an employee, or you don't have to contribute at all. So let's say that Marta decides that she's going to provide her employees with a contribution of $3,000 of their salary in 2020. We're going back a little ways, right? In 2021, she didn't contribute anything. She decided she wasn't contributing anything, and this had to be documented. 2022 was a good year. She contributed 8%. And then back in 2023, she went down to 3%. So with a SEP IRA, you can vary the contribution that you're making for your employees or not contribute at all. Now, one of the things about a SEP IRA is that your employees are vested from day one, right? So if they leave, they do get to take with them all the contributions that you make. And again, with a SEP IRA, the employees do not make their own contributions. Everything is provided by the employer.
Jen,
right. Yeah.
I hate to interrupt you, but I just want to give you a heads up that we're at 12:23 right now on our time.
Great, thank you. We'll move through. Thank you so much. All right, so like I said, we have a lot of content today. So we have scenario D, right? Now this is if you want to provide the same contribution every year. 2 different types of retirement plans we would recommend. First one, again, simple IRA. Employees can make contributions directly from their payroll of up to $15,500. If you're over 50, they can contribute another. If they're over 50, they can contribute another $3,500 more. Those contributions are pre-tax. They don't pay the tax now. They pay it when they withdraw the funds. Employers they must choose one of 2 options. One is a 2% non-elective contribution. So that means that you have to provide contributions for 2% of an employee's salary, whether they save any money or not. Or you can do a one-on-one match between 1% and 3%. So you contribute when the employee contributes, you contribute. The employee can only contribute up to up to the employee's maximum, right? So the match could be 1% for 2 of every 5 years. You basically just keep in mind, we'll give you an example here. If you offered 1% in the first 2 years, you have to match a higher rate in the 3rd year. So let's say Erin opts for 2% non-elected contribution. She has an employee who makes $45,760. Erin needs to contribute $915.20, regardless of how much the employee contributes at all. Our second scenario, or second little scenario here is that, let's say Johanna decided to offer 3% match. Her employee makes $45,760. The employee contributes $2,288 each year, which is 5% of her salary. Johanna will have to match the full amount up to 3%, which would be $1,372.80. If the employee made no contributions, Joanna does not contribute either. So you can change the amount that you're contributing, but you have to notify employees 60 days ahead of time. All right, boy, do we have some options here. All right, if you want to contribute more as an employer, or you want to have vesting options so that employees have to stay a period of time, look into a 401k. It's the best known, right? Everybody knows about it. It's versatile, but it does take time and money to set up. There are advantages. There are higher contribution rates. You can contribute up to $22,500. If an employee can contribute that, they can contribute another $7,500 if they're over 50. Higher employer contribution limits, so it depends on the plan. It's usually up to a total of $66,000 is the most an employer can contribute. They have a lot of versatility, all right? So you could possibly make pre-tax contributions or post-tax contributions. Now, whether you go with a simple IRA or a 401k, speak to your tax preparer again about that retirement plan startup cost credit so that you can receive the credit there per employee, as well as for your startup costs. And if you want to contribute more as an employer or have vesting options, the 401k plan is the way to go. And again, it's the most common of everything. So of all of the retirement plans, everybody hears about 401ks there. And again, there are some great advantages in terms of the high contribution, the high employer contribution, a lot of versatility. So whether you go with either one, also think about the retirement startup cost, the startup cost tax credit. So you want to keep thinking about the tax credits there. Other types of retirement plans, there are traditional IRAs, which are great for individual investors, but they do have contribution limits that are lower than individual or solo 401ks, so you can't save as much per year. Those contributions are from your personal income. They are considered to be tax deductible. The dollars are taxed as they leave your company, which is through self-employment tax. Contributions to solo 401ks that are made directly from your business are not taxed when they leave your company. As such, it's less common for businesses to select traditional IRAs over the individual or solo 401k. There are mega Roth backdoor conversions. They're complicated. They involve a commitment of large amount of funds over time. You definitely want to speak, well, for all of these, you want to speak to a financial institution because this may not be the right option for you for your particular business. That's the same case with profit sharing and the same thing with defined benefit plans. All right, so how do you get started? You've looked at all of these different options. Depending on the level of your organization, you may be able to set up a plan online, or you can go to major plan providers like Fidelity, Charles Schwab, Guideline, Vanguard. They make it simple to set up plans yourself, usually in a few minutes. But you also may want to get the support of a financial advisor, which is always a very good idea there. You want to make sure that you ask the right questions. There can be hidden fees that may not be visible up front, so ask how that advisor receives their compensation, understand how you can request paperwork. It's important to have that because it can be difficult to change from one advisor to another. And you want to know if they are credentialed. Are they a certified financial planner? All right, so whether you start your own account online or you use an investor, ask family and friends for recommendations, search online for more options. The internet is a great way to find out all sorts of useful options that you can have. Read reviews on customer satisfaction, so you may find recommendations there. Really consider the pros and cons that you read about online. Review all of the details, find some options that interest you, and do some nice research on that. How much research really depends on the amount of support that you're looking for. So just keep that in mind. You want to make sure that this is, if you are using a financial planner, can you get in touch with them? How are they available for you to ask questions? And then at the end of the day, what's the cost for your business? Okay, because you know, we've shown you several options. You want to make sure that you get the one that offers the best value for the price. So we are right at 12:30. Margaret, do we have any questions? We may have. I don't see anything.
I don't have anything in the chat, nothing
Okay.
in particular.
Okay, so we don't have any questions. Keep in mind, I'm going to give you the email address for Decal, and you can reach out to them with questions there. So I want to thank you so much for taking the time to join us today. You've learned an awful lot about retirement, right? How much you may need to retire, what skills that you have to retain employees, right? So now your options, how to keep your money, what the best retirement plans are. So I want to thank you all for that. We hope the information is valuable to your business. We look forward to seeing you again for another Thriving Childcare Business Academy topic in the future. Margaret, do you happen to know the date of our next webinar?
Our next webinar will cover the topic of depreciation. It's going to be an evening webinar on March 6th.
Great, thank you, thank you. That actually, I believe, will be me that you'll be speaking with there. We do want you to go to decal.ga.gov/thriving to access additional resources and reference information. And as I said, I've got some QR codes here for you. This is to join small group studies. Something that attracts a lot of people is that once a topic is completed, you get 4 GAPDS hours and you are eligible for a stipend of $300. Each topic has 4 virtual sessions. You work within a little small group with an expert coach. Absolutely excellent opportunity. We're hearing wonderful things from our participants. The topics are financial foundations, recruiting, retaining staff, mitigating risk, sales and marketing, revenue streams and growth. We'll encourage this. Please use this QR code so that you could sign up for these small group studies. And Margaret, is that link in the chat?
Yes, both the
Okay.
link to the Thriving Childcare Business Academy website and the intake form for small groups and one-on-one coaching.
Perfect. So Margaret's put everything that we need in there. So that's great there. Again, these are the topics. So take a look at those. We also have one-on-one coaching. I should have said, excuse me, I want to go back for a second here. Apologize. These are actually the one-on-one topics. They're the same topics as the small group studies. I apologize, I flew through that. So you can do one-on-one coaching on any of these topics. This QR code can help you go ahead and sign up for one-on-one coaching. So we have that. We also offer tax education coaching, and what that is that you supply your 2022 tax return, and the coach looks for things to help you with opportunities with missed deductions, areas where maybe you're filing the incorrect way, or that maybe you have something on there that could trigger an IRS audit. So this is also a great way. This is additional one-on-one coaching that you can reach out for. And then we do offer one-on-one coaching for the ERTC and FFCRA. Not going to go into that in depth. However, I'm just going to say, if you have already applied for the ERTC, received your checks, and had a company prepare that for you, you may want to do some research to make sure that you're qualified, because the IRS is now auditing claims going way back to the beginning of the process. There's something that's called the Voluntary Disclosure Program, and it actually, if you receive the money incorrectly, even though you didn't intend to defraud. We know that some of those predatory companies bent all the rules, and now the IRS is catching up with that. Voluntary disclosure program, you can Google it, but we also teach you about it in ERTC and FFCRA coaching. The ERTC coaching also can walk you through how you would be eligible if you'd still like to pursue that. And then I'd like to thank everybody for joining us here today. Thanks for hanging out a few minutes late there. Please, again, go to the decal.ga.gov/thriving website. You'll see their library of guides. You'll learn about their upcoming webinars, and you can register for small study groups. Again, on financial foundations, recruiting and retaining staff, mitigating risk, sales and marketing, revenue streams and growth. If you had any questions about anything that comes up today, please go to the Decal website. You can reach out to them and they will help put you in contact with us. We'd be happy to answer any questions. So with that, thank you so much for hanging in there with us. We had a lot of information today. Again, have any questions, reach out to Decal. They know where to find us. We work with them on a consistent basis. We're thrilled to be working with Decal. And I hope to see you all on the 6th, and we'll talk about depreciation, which is a topic that a lot of people have questions on.